Is T. Rowe's Chief Investment Officer, and he is with me on set. Welcome. Thanks for coming up. It's good to see you.
Thanks for having me.
So what happens now, right? Seasonality, they say, is on our side. Do you believe that is enough?
No, I would say I'm a bear. I'm a reluctant bear. You know, the bearish narrative is just so compelling. We talked about it last time I was on. LEIs are flashing red, yield curves inverted, housing heading down, concerns with commercial real estate, and on and on. Stocks look expensive. Earnings expectations are for positive earnings growth. That looks optimistic.
Well, why are you so reluctant then? It sounds like you should be bearish based on your view.
I'm a reluctant bear because, first of all, you have to have more conviction to be bearish than to be bullish. Scott, stocks beat bonds 72% of the time on a rolling 12-month basis, historically by an average of 6%. You know, I love watching your show. You often have a bull and a bear. To me, it's always harder to make the bear case. And right now, what makes me reluctant is that all these indicators coming down, PMIs dropping 16 points, they're all from very high levels. We're taking liquidity out of the system from very high levels of liquidity. PMIs are dropping from very high levels. Atlanta Fed GDP is still at 3%. So it's an uncomfortable sort of bearish position, but I just can't get away from how compelling the bearish narrative is.
We're on the doorstep of 4,100 on the S&P, literally as we speak, and who knows, we may end up hitting that level while we're having this conversation. Is that a confirmation signal or a sell signal to you?
It's more of a sell signal. You know, if you think of where the price-earnings ratio is on the market, right? You talk 17, 18. That means that stocks are actually more expensive right now than they were before they started selling off in 2022, if you adjust for the level of rates. We are in a higher rate environment, so we need to rethink valuations. They look high right now.
Okay. We have this Delivering Alpha survey, okay? And by the way, you're not alone, right? The bearish case is very easy to make. 68% of those we asked said the S&P has more room to fall. 16% said closer to a bottom. Nobody, hardly anybody, believes that we are at some beginning stage of a new bull market, though there are those who would suggest it's 2 quarters in a row up. You don't see that in a bear market. Maybe the bears are wrong.
You know, inflation is sticky, and the Fed is still in play. And the Fed is going to, I don't think the Fed's going to cut 3-4 times like you would imply from the Fed fund futures.
You think they're going to cut it all?
I think they might stay for the rest of the year. It would take a major event for the Fed to cut. So I don't think the market is pricing that right now. And let me just say, Scott, this banking stress is just one more negative, one more bullet for the bears.
But you don't think we handled it, if you want to put that in quotes, handled it rather well, right? I mean, the response was pretty quick.
Yeah.
It was pretty dramatic. Look what the stock market's done since then.
The stock market
doesn't compel you in any way?
Yeah, look, and by the way, we're invested. We're just underweighting stocks. Right? I don't like to say go all the way to cash. It's just putting some nuance here. I think we handled it okay. The stock market likes how we've handled it. There's this question about what are we backstopping, right? Yellen didn't say we're going to backstop all deposits everywhere. She said we're going to backstop deposits only if there's a systemic risk in a bank run. Now, I can ask you, how can a bank run not be a systemic risk in the current environment?
In other words, so why isn't that implicit then from Yellen that they will backstop deposits if necessary?